Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Today, we are here live in Silicon Valley, and we are trying to help you improve your retirement, at least in a financial sense. And we do that by answering your questions. So feel free to send those in now. You can send them in via email. Ask Tom at talkmoneywithtom.com. You can send them into the chat if you want to sign into the YouTube channel. And we'll try to answer those live. You can send them in during the week, and we'll, have a chance to maybe look at them and study them a bit also. So we really focus on, retirement planning, asset management, and tax planning during retirement. However, no matter what age you are, these are things you can take a look at, whether you're looking forward to retirement or already in retirement, to try to, improve your retirement, whether it's in the future or whether you're already living it. And so we've created this channel because we feel like there's not a lot of educational resources out there around these areas as a whole. We specialize in retirement, so this is something I think, that we have it's in our wheelhouse, so to speak. We have over 1,500, videos on our channel. You can go to the channel there, subscribe, hit the bell button, and get notified when we put new content out. Of course, you can always just meet with us if you'd like. Ethan and I are available. Our calendar is live on the internet there. You can go to our webpage, which is links listed here on the channel. Hit the book appointment button and go ahead and set up a half-hour time, to meet with us. And so that's what's happening, at least with the show. And so I'm very excited about today, actually, because there's a heck of a lot going on. A lot to talk about in all kinds of different areas, but especially in the market as a whole. So I do like to start off every show really with a summary of kind of what I've seen happen in the market. And again, there's a lot happening here. So let's break into this. Actually, I'm going to use this shot today for starters. Okay, so this is, a chart going back to 2018. You can see the pandemic, the big drop in there and the big run up, the inflation drop that we had in 2022. And then we've had this pretty fantastic run, since the end of October last year. But we're in the middle of a downturn, about 2.5 weeks here, right? And then today is down quite a bit, 2.5% range, and there's some reasons for this, and we'll talk about that. And so really what's happening is that it's interesting. We've shifted from this big concern about inflation, core PCE inflation, which is what the Fed looking at, has come down to 2.6%. But the Fed just met this week, and on Wednesday they came out and said, we're not changing rates, and that was the expectation.
Yep.
If you look at the futures market, the expectation was that there wouldn't be any rate change. However, during the commentary and the question and answer for Chairman Powell, in my opinion, he basically was saying, hey, we already see the data to be able to do a rate cut, but we're going to wait until September. I thought he didn't say that directly, but I wasn't the only one that saw that. I saw several other quotes. And now we're seeing a whole bunch of different pieces coming out. Since then, we've gotten some weaker economic reports, factory contraction yesterday, housing slowing down. We've got this situation where today, the number of jobs created was less than expected, right? Supposed to be 175,000 jobs created. Turned out it was 114,000. To me, that's still pretty good. I mean, there were points in time where 114,000 would have been celebrated, but the market's kind of worried about that.
Yeah, unemployment jumped to 4.3%, which is above the Fed's long-term projection of 4.2, and so the market's now getting kind of antsy.
Yeah, and I guess part of the antsiness is that the next meeting isn't next month like it normally would be. They skip August. They have a Jackson Hole meeting with a bunch of different Fed governors. They'll do a speech of some type, and sometimes that can have an impact. But their next meeting to do a rate cut isn't until September 18th. So it's a long ways away, and we've already had, even just the last couple of days, some data showing slowdowns. And the biggest issue, in my opinion, is that the Fed isn't really an organization that the market trusts. Rightfully so. If you go back in time and look, even in this last situation, we had this high inflationary period, and the market was talking for a year that they should have been raising rates. And no, it's transitionary. It's not going to, it's going to go away. It's part of pandemic driven, it's supply side. And they were probably right to a certain degree. But in the end, having zero interest rates during that period of time with all this pent up demand coming out. And we ended up with a 28% stock market drop as they were rapidly raising rates from zero to, a top number of 5.25, right? And so now they're at 5.25. Again, there's a range. It's 5 to 5.25, right? So it's we'll just use the top range, and the market is now worried that, oh, they're going to make the same mistake on the other side.
Yeah, we've held rates. I think it's been a year now.
Yeah. The last time they raised rates or held rates was in July. So yeah, a year, and this Federal Reserve is impacted, and they've mentioned this many times, by what happened in the 60s and 70s. That Federal Reserve saw unemployment start to come up, and they have a dual mandate, trying to keep full employment, which is 4.2, 4.1, whatever you want to call it, or less, right? We're above that at 4.3. And try to keep inflation at 2%, on this PCE core index, right? And so now we're above that, and the Fed back then lowered rates, and then inflation really got out of control. A little different time frame. I mean, oil went from $4 to $40 a barrel, which is an amazing percentage increase during that period of time, and such too. There was things that were different, but they do not want to be the Fed that lets inflation run away here. I think they're looking at it it's so different and such a different situation that I think they might be making a mistake here. And honestly, predicting that the Fed will make a mistake is a pretty easy prediction. I mean, in my career, I've been doing this for 38 years. I can only remember one time that the Fed got a true soft landing all the way through, and that was in 1994. And so far, we've had a soft landing, and we've celebrated that, and it has been really good. And we're really far away from a hard landing.
Yeah,
right?
It's been a pretty slow glide now,
Yeah.
just slowing down.
Yeah, and so I personally feel like the market's overreacting here, and I'll talk to you why, and what you might want to do and those types of things. This is a seasonal time frame where the market has a tendency to be soft. Certainly was last year. Hit a peak on the 31st of July. This peak hit on the 17th of July, right? Or the 16th, actually, started down the 17th. And then, we hit a low point on the 27th of October. There's a 10% downturn. It was kind of dramatic, several little run-ups in there, but nothing that great. It felt like things were going to go down even further. But it didn't. And then things turned around, because the basics were still there. And the basics are still there now. We just had a 2.8% annualized gross domestic product, growth report for the second quarter, which is very healthy, really, especially for the size of the U.S.
Yeah, and when you actually look into the unemployment numbers, a lot of the unemployment numbers jumped because so many people joined the workforce. For your working age people, we are at the highest since 2001. With 84% people are participating in the workforce.
Yeah.
And so when you add 400,000 plus people to the workforce, not everyone's going to find a job in the first month or so.
Yeah, and so I think that was a big problem coming out of the pandemic, was workforce participation. A lot of people just weren't coming back to work for whatever reason, and now we're starting to see that rectify itself. You need to have those people in the workforce to kind of combat inflation, because the biggest area of inflation has been mostly on the service side, right? Which takes people for the most part to work. And so, again, I think this market is kind of overreacting to this. And so let's just talk about, first of all, every downturn is potentially the beginning of a big downturn. That's a fact, right? But every downturn doesn't turn into a big downturn. Most downturns don't. And so how do you kind of tell the difference, and what do you do and such too? So I'll switch over to a different view here so we can see this a little closer. But, here's our, primary trend piece. Now, this is not a predictor. It's just kind of showing, where the market's at right now, and how deep are we into this downturn, right? So if you look, we still have, and these basically, columns come up when there's a change. So the last change was July 18th. The hourly, portion of our primary trend turned down. So as of July 18th, we have, that's, pretty good. That's really near the top. We haven't been using new money that's coming in, hasn't been invested. We've been accumulating that as cash. Worked out okay so far. The market's down quite a bit since July 18th. And so that's what we use that for, right? But the daily, the weekly, and the monthly are all still primary trend up, no doubt. And I'll show you some of those pieces there. So, you shouldn't really be reacting. I wouldn't trade on the hourly. We just use it for new money coming in. We love to get new money in and working in the right direction right away, right? It's just important. It's a psychological thing for clients, especially new clients. as far as that goes. And then we got kind of breadth. We're looking at Vanguard total stock market, the S&P, the Dow, the Nasdaq 100, the QQQs, the small cap and semiconductor, utilities and transportation. These have all been, now this is a longer term thing. We're looking at weekly data. They're all still in primary trend up. The one that's actually closest is the semiconductor to turning into a down. So, and that's at least partly because it just skyrocketed so quickly, and the snapback is one of the problems with going straight up. It always kind of worries me. If you go straight up, there's no support, and you just can come straight back down, and then sometimes that down should stop if it was just a normal, but if it's come down so much, people start to panic, and it starts to turn into a thing, right? Even though I think it's one of the most amazing areas of the market, especially with the number of sales coming out. AMD came out with their report. It was very good.
Yeah.
I bet you NVIDIA does well. They just keep beating the expectations. So, we'll see how that plays out. But just recapping a little bit of what was happening last week, we talked about kind of the small caps versus the S&P 500. Mm-hmm. And so, if you looked at that over the last month, the small caps were higher than the S&P 500 by a lot. That's still true, but it's not as much. And so I'm just showing what's happened in the last 5 days. The orange is the small cap, and the green is the S&P 500. And so small caps were running because if the economy is still strong and they're lowering rates, that's a perfect
scenario for them.
They're economically sensitive, and they're sensitive to interest rates because they hold a lot of debt. Especially small value, right? So now, if the economy is starting to slow down, well, they're economically sensitive. So that's going to be a problem. So that trade could be over already, which is amazing because it's just a huge run. I think it was up 11% one point or 13% one point, month to date in July. It was crazy. Historic, actually, big jump up. And so, again, you got to be careful with some of these trends, especially in these more volatile areas. Let them develop. We put a little bit of small value in a couple of our portfolios. We'll see if that sticks. But, you want to dip your toe in. Really got to be careful with some of these trends because as I have seen this small cap trend, it's a little bit like the international trend. It runs and then it stops. And so, stick with the things that tend to run more often, even if they're running a little bit slower. In my opinion, it's a lot easier to deal with. All right, so let's talk about where we are in terms of trend and what you should do and how this works as far as that goes. And then we'll talk about why I think the market might be overreacting a little bit here. So first of all, here's the chart. I've got the green arrow showing the lows. Okay, so using primary trend from, Charles Dow, going back, over 100 years ago, what he talked about was that as long as the lows are higher each time, it's one of the components of being in a primary uptrend. And so we can see that. And I drew a purplish, bluish line there where the last low was. And that red arrow says, okay, if it gets below that, that is one piece of the puzzle of saying, hey, the primary direction has now changed to a downturn, right? We are this is fairly up to date. This is really a few minutes ago. We're quite a ways away from that point.
Yeah.
Matter of fact, it's from that peak point to that, it was 12% drop just to get down to that, last low, which was 49.67. All right. So we got some room here, right? Just like we did last year. If you look at that big downturn last year, we had a lot of room, right? Mm-hmm. So part of the reason we had such a big downturn last year is we had a huge run up from that last low, which was actually in May through the end of July. And that was after the NVIDIA first blowout earnings, right? Mm-hmm. And so sometimes you get these big run-ups. You're going to get a bigger downturn before it finds its bottom and comes up. But it never created a new low. We stayed in, and then boom, the market just took off. So you got to look for that again because that's probably the most probable scenario. Always assume that you are in a certain spot based on the current data. So the current data says right now we're still in a primary uptrend. So you're still in a primary uptrend. So don't get too crazy about doing a lot of different things as far as that goes, right? And so, all right, so that's number one. Number two, and again, I'm using very simplified things here so everybody can kind of understand this more. The yellow line is the 50-day moving average, and the blue line is the 200-day moving average. So when the yellow line is above the blue line, we are in a primary uptrend, right? We're moving upward. That's really far away, right? It would take a while for that to develop. So when you're in a primary uptrend, you basically want to stay in the market for the most part and use kind of a let me show you kind of what we do. All right, this is called a heat map, and so this is in our ETF universe. We have 181 ETFs in our universe, and so once a quarter we go back and we back test this universe, and what we're looking for is really, you know, which ones are moving the best, right? And so, but what do you look at? How many days back do you look to see, you know, okay, this is the wave I want to be on, and then how long do you keep it within that realm? So if you look at the vertical column there, it goes from 5 to 130. So what that means is the number of days we're looking back. So we go and we take our data. We start with the beginning of 2020, mainly because we want to see a lot of different cycles. We get to see the pandemic cycle, we get to see the big boom in 2021. We get to see, you know, the big rocky downturn that happened in 2022. We get to see this explosive situation that's been happening in over the last 12 months. And so what we're looking for is a lot of different cycles and scenarios and types of markets to have a robust test as much as possible. And so across the bottom here is the number of ETFs, right? And so here, let's just say it's a 10 ETF universe. We have 16 sub universes out of our 181 ETFs, from small as 4 to as high as 175. And so it depends, because we have different models. We have you know, taxable investments where we want to move slower. We have tax deferred and tax free investments where we're more willing to move quickly because there's no taxes. We have ESG, we have traditional, we have green, right? So we have 16 different sub universes. And we also have, amongst all of those, core, which makes up about 3/4 of every model, and then target, right? So core is more diversified, broad, target can be narrower. Like semiconductor index, you know, which we sold a while ago, which looks actually looking good too. We did really well on that run. Is, you know, one of our targets because, you know, it's a narrow area versus, say, the Vanguard Total Stock Market Index, which is completely broad. Yeah. And so, and what we're trying to show you here on this heat map is that when you back test, you have to be a little bit careful. So if you look at that first one there, 52, that says the look back period was 10 days and you had to be in the top 5. The 52% return being green means that it is beating VTI, the Vanguard Total Stock Market Index, right? But it's surrounded by, you know, red, yellow, you know, orange, basically. It's like an outlier. And so what you really want to do is, and they say 57 is higher, but it's still surrounded by a lot more, you know, lighter color green. 55 is the key, right? So you want, in this particular case, you want to look back 55 days. So you're comparing all of the pieces in that universe for the return for the last 55 days. And no, sorry, what is that? I'm looking across there. 65 days, 55%. And then, you know, it has to be in the top 7. So once it falls out of the top 7, you're moving back to whatever's at the top, right? So here's the reason that works so well. Within that universe, you can have all kinds of different things. So for example, within our target universe, which is very large, right now, we just moved today into some more utilities and some more real estate, right? Because those are doing better and moved up, and a couple of our other pieces fell below the cut line, right? Specifically, mega and large cap growth, right? Which, you know, everybody knows that's struggling right now. And we moved into pieces. Now, these are small, you know, targets are 4 to 6%, you know, across the board. And we're making small adjustments as far as that goes. And we've actually had utilities in our portfolio for quite some time now. Utility is a weird combination. It's actually become an artificial intelligence play that really revolved around all the earnings reports and the CEOs coming out and gushing about the demand increase, specifically from data centers.
Yeah, basically, there's been sayings the internet's running out of power.
Right, and so that's a good thing for utility because they sell power, right? I mean, so they've got that. Plus, they can be seen as a safe haven. So when the markets fall, you know, like today they fell, but not nearly as much as the S&P 500 because they're a defensive play. Everybody still needs utility, even recessions. They pay fairly good dividends, which is good, you know, those types of things. So they're often a defensive play. Real estate can kind of be the same thing. It's a different asset class. It's out of the stock and bond markets and such too. And so, you know, that's what's happening within this universe. We want to watch for what's moving up. So people ask me, well, what do you do in these downturns? Well, it depends. Are we still in a primary uptrend? We're going to use our universe. We're going to use our heat maps. We're going to let the universe of ETFs kind of tell us what to do.
Yeah, we'll let the market kind of decide, what's rising up to the top.
Right. We want to capture those waves. Do they last a long time? Maybe, maybe not. But our back testing shows that that's a good category to be looking at. 65 days back. In this, again, every universe has a different situation, right?
Yeah.
In this particular universe with 10 ETFs, look back 65 days, cut it out when it gets below the top 7, right? So that type of thing. And so now, what happens when the primary direction changes? Okay, so again, the 50-day moving average comes down in what's called the death cross for a reason. The 52-day moving, you can see one back there in 2022.
Right around that March. So.
Yeah, and that turned out to be a pretty good sign. The market did continue to fall quite a bit. It wasn't the top.
Yeah.
I don't believe in trying to get the top. Matter of fact, I back tested trying to find the top. You can't even back test it knowing when the top is and reliably get a situation, at least in my opinion and my experience, using these longer term pieces and staying in there. And this really works well. And of course, then applying Charles Dow's lower lows again. So we get below 49.67 and the 50-day moving average. Now we got a different system.
Yeah.
Okay. So now we're in a primary. Let's just say, for example, we're in a primary down direction. What do you do then? And so in our testing, what we found is that we need to change the universe as things happen. So in other words, what we do is we use something called point and figure charts. These are 3 different point and figure charts for the total bond market index from Vanguard. Each one of these has what's called a different box size. Again, Charles Dow was a huge proponent of point and figure over 100 years ago. So these have been around for a long, long time. And I won't get into too much detail about it, but what it does for us is those signals that we show, where we show green and red, and that's where we start to use the signals. When we're in a primary up direction, I use the signals just as kind of informational. When we're in a primary down direction, they're actually actionable, right? And so when we get a yellow signal, what happens is automatically the universe reduces down in terms of the standard deviation. We do not want to have pieces in our portfolio that have higher standard deviation than the market itself, like semiconductor. That would be moved out in a down market for temporarily, and we would move down to things that have the same standard deviation or less than the market itself. We're still in.
Yeah, so you think of like consumer staples,
Yes.
kind of like there was more cyclical stuff.
Yeah, exactly. A lot of stuff fits within the total standard deviation of the market. And what we use for the market is the Vanguard Total Stock Market Index, VTI, which has some small cap in it. And so it has a little bit higher standard deviation. It gives us a little bit more room to capture everything. When we get a red signal, that's when we move into T-bills, right? And so that when we're in a down market, it's a different situation, right? When we're in an up market, you have to stay in. Maybe you get more conservative because the ETF universe is floating upward, with those more conservative pieces, like what happened for us today with utilities and real estate. And, what happened, we moved out of stocks, a week or 2 ago, right? That type of thing. So, those rotational pieces, I don't know. I really like that concept altogether. It works quite well as far as that goes. So anyway, that's what you do, in my opinion, in these types of markets. Bifurcate your trading strategies depending on whether you're in an up market or down market. Because in an up market, you want to ride that. You want to be in there because, last November we were up 8.9% after a 10% downturn in the market. So you got to stay in there. When you're in a down market and it's an erosion and you're truly coming down and the primary direction has changed and we've had a death cross, you want to have maybe a different philosophy because you don't know how far that might go. Are we going to go down 20% or is it 60, right? So that you kind of want to be more careful as far as that goes. So anyway, that's strategically, how we handle it. And this has been, 38 years of experience, actually more. I started when I was 12, so I'm 48 years of experience, I guess, but professionally 38 years ago. And so, that's the process. So here's the next thing I want to talk about. It's just where I kind of think the market might be getting a little bit carried away with some of these numbers. So this chart here, I know it's a little hard to see. This is the unemployment rate from 1995 to 2000. Okay, This is the greatest run, 5-year run in the history of the stock market. This is the dot-com bubble. It's been, used as an example for what might be happening now with the artificial intelligence, right? It's a big change. It's an exciting development. We'll see if it truly plays out, right? We were questioning the dot-com bubble at that time too, but it certainly, here we are live streaming on YouTube, and we couldn't have done this before 1995, right? And so what you see there is at the beginning, we were at 5.5% unemployment rate, even though the market was taking off, right? So the market just freaked out today because we went from 4.1 to 4.3%, and we only created 114,000 jobs.
Yeah, we're still at historical lows for unemployment.
Yeah, exactly. And Matt, this one ended up at 3.9%, which actually isn't that far from where we are now, right? Unemployment was coming down during that period of time because there was a lot of growth and things were happening and what have you. But the basis of this took off, and 95 was a fantastic year, in a higher unemployment situation than we have now. So unemployment tends to be a lagging indicator anyway. But the other thing that I think is interesting is just where the Fed funds rate is, all right? So this took off at the Fed funds rate was at 6%. So we're at 5.25%. Now, they did lower it over a period of time. What's really a mystery to me is why they were lowering rates, going into 99, because it was really taking off. And then they had to play catch up. Again, the Fed Reserve, in hindsight, made a mistake there.
Especially with unemployment going down.
Unemployment's going down. The economy's flying. The stock market's going nuts. I think in 98, the NASDAQ doubled. And they're lowering rates in 99. So, hey, again, this is why the Fed, sometimes is questioned on what they're doing. And we ended up with, the Fed going nuts on the upside and then essentially crashing the stock market. And we ended up with a 45% downturn. So, this is what's happening as far as that goes altogether. And I think that the Fed, they're in a blackout period, right? When they get out of the blackout period, don't be surprised if you start to see them saying nice things about the economy and the stock market, and trying to maybe soften up the blow for maybe making a mistake and not lowering rates this week, right? The bet for a 0.5 point cut has skyrocketed in September. I saw a stat that it was at about 29% a week ago, and now it's at 70% today.
Yeah, so the blackout period ended, I guess, yesterday.
Ended yesterday. Okay, so Monday, start to expect some interviews with Fed governors. Let's see what they say.
They're likely going to say the economy is a lot stronger than people are giving credit for.
Yeah, well, we just had a 2.8%, gross domestic product for the second quarter. That's a pretty good number. And so, we'll have to see how this plays out. But then expect probably the Fed in their Jackson Hole meeting, conference to be fairly positive there also. And right now the market's expecting a 0.5%, rate cut. I said yesterday the problem that the Fed's going to have is that this is already political, right? There's been articles claiming that maybe the Fed is trying to make Trump win by not cutting rates already. And then there's other articles talking about how the Republican Party is saying, boy, they better not be cutting rates before the election. Now, interview after interview after interview with Fed governors has said the same thing, that politics does not enter the room when they're talking about rate increases or rate cuts. Pretty convincingly, actually. However, we're all humans, and there's a pressure standpoint that's going on. I do think it'll be harder for them to do a 0.5 point in September before a presidential election, even if they say it isn't. So, we'll see how that plays out. And it would have been easier, honestly, if they'd have done a 0.25 point and then another 0.25 point, to July and then September.
I think the crisis, the previous inflation crisis, how it rebounded is still weighing on them.
Yeah,
they rather see unemployment go to 4.5 or much higher than risk inflation coming back.
Yeah, they actually had at the very beginning of this a 4.4%, expected target that it would get to before inflation could come back down. So far, maybe they've been right, and so I agree with you. Actually, I do think. I guess in another way, they probably would rather have a recession than have inflation get out of control. I guess I would too, in a way, but it'd be really nice to avoid both.
Yeah.
Just just asking, and just to see what happens there. But anyway, that's what's going on. I know this was a little bit longer than normal, but there's a lot more happening right now than normal. Also, it's a really fascinating time frame. So anyway, look forward to being able to talk to you next week. Now, we aren't having a show next week, but I will be doing a summary for what I saw happening in the market. Matter of fact, we won't be doing a show for the next 2 weeks, right? Just because of vacations and such. So, okay, well, let's get to our first question.
So, do we ride out this volatility, or do we get defensive? You stated that how you're seeing some more, lower standard deviations ETFs come up. Is that getting defensive, or is that kind of, just changing what's riding different waves?
Yeah, the way that we have our portfolio set up, when we're in a primary direction up, we're looking at this ETF universe. We have a big one of 181, and there's 16 different universes, that are sub-universes, and there's some overlap in there and what have you. And so what we're doing is we're letting that ETF universe tell us what to do. So we optimize, how far back we look when we're looking for performance, and then how long we keep it in terms of the ranking. So if you have, 60 of them, do we keep it when it drops out of the top 10 or the top 30 or 40 or whatever? So we know those numbers. And so then we just kind of let the ETF universe tell us what to do, right? And so our targets in a couple of our subcategories move today to utilities and real estate, away from mega cap and large cap growth.
So they're lowering the standard deviation, but we're still in the market.
Yep.
If T-bills are at the top, then we'd likely start to rotate into those.
Yeah, because T-bills are involved in a lot of these universes. So if T-bills move all the way up to the top and the other pieces fall below those cut lines, we will start to accumulate T-bills in those areas. We're not seeing that.
Yeah.
No. And so we are getting a little bit defensive, and those are only in the target. So we still have our core that's fully invested in the broad markets and what have you. And it's very important to kind of know where you are and know what you should be doing, because I think last year is a great example, and I'm really happy with how it worked out for us. We got a little bit defensive when the market was coming down, but we stayed in for the most part, and then we were there in November because it moved 5% in a week and then 8.9% in a month. And you could miss that out really easily if you were fully out of that market. And the reason it moved back up so much is because we weren't really deteriorated as much as a lot of people seem to be talking about. In the end, we were still in a primary direction up. The 200-day moving average was still below the 50, and we hadn't set a new low, for example. So, you got to know where you are. Are we in a primary up or primary down? Because it makes a difference. It's kind of like a tide, actually. It's just you've got to fight that tide, and you want to, go with the tide. The tide right now is going up, not down. I know tides don't go that way, but they're in and out. But nonetheless, so that's in terms of riding out this volatility. We have ratcheted down some of our targets, little bits and pieces. Not strategically, it's just because that's what our data shows us and what our ETF universes are telling us to do, and we kind of execute that, and we've had good success with that. I like this process actually a lot. So it's a great question. Hopefully we'll be able to continue to answer those and see what's happening as this develops.
So next question is, I want to be aggressive with my retirement spending. I don't have any beneficiaries that I really care to, give my nest egg to. So my goal is to kind of spend as much as possible in retirement. How do I improve my failure scenario if I do run out of money? How do I make that kind of floor a little bit higher?
Yeah, this is an interesting question. So, what was the old joke? I want to bounce my check to the Undertaker type of thing, which is it. It sounds funny and it sounds good in a way if you're trying to spend everything. I accumulated all this, I suffered to save it, now I want to spend it. Well, there's several scenarios that are problematic. Number one, you don't know how long you're going to live.
It's hard to spend it all.
It's very difficult. And number two, you also don't know what your performance is going to be in the investments that you've got. They could be spectacular, and you keep spending and spending and spending, or you're spending and spending and spending. All of a sudden, we have a 2008, and whoosh, now you're in trouble. So, but there are a couple strategies that we would recommend in this particular scenario if you're really trying to maximize how much you can spend. Go ahead.
So you want to kind of you're gonna always have some. Likely will have some sort of cash flow in. So how do we maximize that cash flow in? So if you have Social Security, may you defer from to as late as possible till 70. That way you get your biggest guaranteed kind of income for the rest of your life. And then you can also think about putting some of your nest egg into an immediate annuity. You start to generate that income immediately, and it kind of guarantees that for the rest of your life. So you're giving up some performance and some ability to reach upside, but you're guaranteeing that you have that income.
Yeah, so make your base cash flow as high as you can, right? Within reason, right? I mean, you don't want to put all your money into that area because you still want to spend that money, you know, as much as possible. So maximize your Social Security. Great idea. I mean, that way, you know, if you live a long time, you'll still be getting as much Social Security as you could have gotten, and you get the cost of living increases and everything. And then the immediate annuity is where you take some money, $100,000, $1 million, whatever it is, and you give it to an insurance company, and they give you an income for life. Now, that money that you gave them is gone, right? And once you die, so is the income. Now you can get joint life for you and your spouse, so the second one of you keeps getting money. There's a whole host of options. You can get, you know, single life with 10 years certain, so you get at least 10 years worth of income. So if you die in the first year, your beneficiaries get it for 9 years, you know, whatever. But it's a great way of kind of maximizing the income out of a pool of money. And so you maybe would take a section of your assets and buy an immediate annuity. So between the Social Security and the immediate annuity, you now have this cash flow. Now, we have these other assets. And so we want to spend those down as much as we can. And so what I want to do with that, I want to keep running every 6 months a Monte Carlo simulation on your scenario, because I want to see what's going to happen in a big downturn. And this is where you got to be flexible.
Yeah.
So if I want to spend $200,000 a year, I've got 50 coming in or 75 coming in from immediate annuity, Social Security. So I'm spending this other money, We have a big downturn, and all of a sudden your Monte Carlo simulation, you know, shows that, hey, you're going to run out of money, right, before your target date time, whatever that might be. And then you should be backing up on your overall spending and just be willing, you know, hey, hopefully you're overspending on your lifestyle to really have fun, and you're able to cut back to kind of a more normal lifestyle for a while, and then make it up again when the market does recover, when that comes around.
And maybe you don't try and spend all your money, but maybe you target a small figure. You know, say I want to have 200,000, end my life with 200,000, so I spend majority of my money. That way, you at least have some sort of, you know,
a buffer.
Of what you can do.
Yeah, it sounds great, and it sounds easy in a way. It's really, really difficult to do, and it's quite dangerous if you don't know what you're doing, and if you don't know how to do it. You've got to monitor it, because you really, you know, I mean, who wants that? Who wants to get, you know, hey, I lived it up and then I'm still alive and now I have no money and my Social Security's small and I have no other income source. Now I'm living off of just this small Social Security, and boy, I had a lot of fun at the beginning of my retirement, but now I'm suffering and having to do things I don't want to do.
You want to try and maintain at least some sort of standard of living throughout the rest of your life.
Yeah, exactly. So it's not an easy concept, but it is possible. We have clients that we're working on this with. I think this is where we can really help, actually, you know, running that Monte Carlo situation on a regular basis to make sure that, you know, that it's like the rudder, you know, I mean, the boat's still going in the right direction. It's not a bad concept, actually. I mean, why not? There's no beneficiaries that you really, you know, are really invested in. And so why not? Somebody else is going to get it.
So something that's been popping up in the news today because of the unemployment is what the Solomon rule. So what is the Solomon rule, and why is it worth knowing?
All right, so this is kind of interesting. Let me share the chart here. So just in a broad sense, I'll let you describe kind of what it is.
Yeah.
In a broad sense, there are some rules and concepts that have had very high success rates at predicting recessions.
Yeah.
Right? So one of which is when the 3-month T-bill is paying more than the 10-year T-bill, right? Mm-hmm. I think it's a 94% accuracy rating that a recession is going to happen within 12 months. Mm-hmm. Well, that happened about 24 months ago. So, and then the other one is the leading economic indicators, which I've talked about a lot. And it's someplace in that 94% success rate too when it goes negative.
Hmm.
Well, that happened about 24 months also ago. And so theoretically, we should have been in a recession last October based on those two. And we're not, right? I mean, we're pretty far past that. And maybe they're just wrong in terms of the timeline and it's still going to happen. So this is one of those. It's got a high percentage of probability,
Yeah.
right? And so, but I just want to couch this with be careful because all of the data that we talked about for the leading economic indicators and for that, 3-month bill higher than 10-year, none of those included a pandemic in that data set.
Yep.
And that's the big difference with what we've been dealing with so far. So describe what this is.
So, this rule was from a former Federal Reserve economist, Claudia Sahm, and her rule was basically if the average of the last 3 months is 0.5% above the 3-month average or the low of the 3-month average of the previous 12 months, then you are headed in a recession. A recession has started.
This has to do with the unemployment rate, which was,
Yeah.
topical because it was just announced today.
And so actually, yesterday, Claudia Sahm basically said she doesn't think the economy is in recession. She says that her indicator is kind of changed in a sense because, changes in the labor supply, the pandemic and the recent jump in the immigration have kind of made this one a little bit less accurate. So she doesn't even feel that this is accurate, but it's popping up in the news a lot because of how many recessions is predicted prior.
Yeah, and this is the data. So when it becomes a signal, when the SOM gets over 0.5% there, you can see, the recession had started in 1953, 4 months before that, 2 months before that for the 57, et cetera, all the way down. And so it's been quite accurate. And even the one that happened there in April of 2020, the recession had started in February of 2020, 2 months before that, thanks to the pandemic. And so I think it's important. It's a good question. It's certainly something that's hitting the news right now. You just have to be a little careful. And she's saying the same thing that I'm saying in a way, which is just this time it's different. I mean, that's what's happening. Everybody's going back and saying, why isn't the T-bill and 10-year thing working like normal? Why isn't the leading economic indicator working like normal? And this is just such a different environment. And unfortunately, some of the data that we have from the past is really kind of, misleading because it didn't have a pandemic. The last pandemic was 1918. And obviously, the data from that time frame isn't really applicable to now. It was too long ago. Anyway, that's that pent up demand and that money coming out has continued to keep the wolves at bay, so to speak, because historically we should have had a recession. When you go from 0 on the lower end target for the Feds to 5.25 on the upper end target for the Feds, you should have a recession. As a matter of fact, Wall Street went nuts in 2023 saying we're going to have a recession.
Yeah.
Remember, that was just everywhere, and they were all wrong. And maybe they were wrong just on timing. Maybe it'll happen in 2025. We're going to have another recession, definitely. But can we get out of this situation that we're in? I think it would have helped to have the Federal Reserve do a quarter point cut yesterday, because again, things are softening up, at least in the labor market, as far as that goes. But yeah, anyway, so that's what this is about, and that's what they're talking about. So, all right. Lots of interesting things happening today. Very fascinating what's going on in the stock market right now. And so, we'll continue. I put out a video every single day on what I see happening with the market. I will be missing, not next week, but the week after. I'll be out of contention in terms of being able to get to do the videos in terms of vacation. But I will do the videos next week. I'll do the summary next week. And again, we won't have a show for the next 2 weeks, but then we'll come back and do the show. So look forward to seeing you then. But again, send in your questions. Give us some chance to look at them. Send them to asktom@talkmoneywithtom.com, and we'll be able to answer those. Obviously, you can subscribe to the channel. There's a lot of good information on there. Hopefully, you're getting something from today, but you can go back and see some of the archives or things that we talked about in the past. And then, of course, you can just set up a time to meet with us, and go to the calendar. Again, you won't find an appointment for the next couple of weeks because it's blocked out. But after that, there's some openings. So set up a time to meet with Ethan and I, and we'll answer your questions. One-on-one, on the phone, in face to face, or on video, whatever works for you. We can do that. So anyway, look forward to seeing you in a couple of weeks. Thank you very much.